Okay, folks, power 3. Alright, the power 3. Before we, as traders, can come to realize consistency in our trading, we first have to understand we only arrive at this state of consistency by understanding the 3 major market cycles. Those being the accumulation phase. Now, the accumulation phase is when smart money accumulating longs and shorts. Second phase is the profit release phase. This phase is typically the trend following or range expansion move. This is the only time profit taking or profit making is permitted. The distribution phase. This is typically when the smart money distributes its long or shorts that it once previously accumulated during the accumulation phase. Okay, we as traders, we're faced with a new trading day or new trading session every time we sit at our terminals. The most important thing that you need to be worrying about is where are we going to go after the open. Okay, above the open, if it's bearish, the move up away from the open is typically where smart money distributes. Down away from the opening is where smart money typically accumulates when it's bullish. If you do not have a bias going into the market and a premise for either being long or short in the market, you will have a great deal of disadvantage, and the odds will be definitely stacked against you for your success. You need to find a high probable direction for either session you're getting ready to trade or the day that you're getting ready to trade if you're a day trader. Alright, the typical accumulation. Folks, what looks like a simple little dash, that is going to represent the opening price for our segment on open to close relationship. Okay, typically you'll see, and we're going to cover a bullish scenario for now, the opening price. Okay, this we're going to represent a daily range. Okay, we'll go into other applications of this concept in other modules, but for now we're going to deal with the daily range. So here's the opening and the initial move down away from the opening. This is typically going to be viewed as smart money accumulation. This is the area where the Judas swing materializes. Now the Judas drops down away from the opening price, leads the street money into the proverbial slaughterhouse. So on bullish up closing candles or up closing open high low close bar on a daily chart, the slaughterhouse resides at the open and below to the low. Okay, that's where the smart money is going to accumulate the long. Okay, on bearish conditions, when the opening price is viewed with a Judas swing up above the opening price and it's overall bearish, this is typically where the smart money is accumulating shorts, okay, or distributing in the market. The swing up from the opening in bearish environments, this is going to be typically classified as the fake out move or Judas swing up into the slaughterhouse. Okay, so the smart money will be doing their dirty work in this region to get short. Okay, the standard up bar. We've determined there's the first 2 phases in the market, and that's the accumulation and the distribution phase. The third portion or third phase in the marketplace we need to be aware of is the most important, really, because without this portion we can't make money. that being the profit release phase of the market. This is where most traders have a difficulty even when they are correct in their trade. Let's assume for a moment this day here that there was a buy signal on your particular style of trading, and you happen to get long and you were in profit, and say this is going to represent the daily bar as well. Okay, a couple hours have gone by and you probably seen maybe 20-30 pips profit, and the remaining portion of the day's range hadn't been filled yet. But because you're relatively new to trading, or you're reckless, and you've been plagued with losses, all of a sudden you have a profitable trade. It feels so good to be in the black. What do? You collapse the trade. Okay, well, for you to make serious money in this business, whether it be trading Forex or any other asset class, you need to have the understanding on how the daily range is fulfilled. And it's based on time and price theory, and we covered that concept in other modules, but we're not going to go into great detail here. But we understand that typically the London Open posts the high or low for the daily range, and if we look for a move coming out of London Open, and let's assuming for a moment that it's a bullish London Open set up for an up close day, this bar will represent a daily range, and you want to hold for at least the New York Open, okay, which is 1200 GMT time, or 7 a.m. Eastern Standard Time. That's what I refer to as New York Open. You may have a little bit different view on it. That's what I use. Then you have the second time profit objective would be 1500 GMT, which is approximately the London close, or very close to London close. Then you have GMT, 1800 hours. Okay, that's about the last bit for day trading inside the daily range. Now, it doesn't mean you can't go further into later New York, but by far and large, you'll see that if you look at 1800 GMT, that typically has the 99% of the range fulfilled by that point. Okay. The standard down bar, and again, this is going to represent a candle or bar for the day. This is the daily range, and it's assuming that for a moment that we are expecting a lower close on the day, and London Open posts the high. The profit release phase on this is basically the same thing, just reversed from a standard up bar. Now, it's very important that you understand this profit release phase goes on for several hours in a day. So when you have the directional bias captured in London Open, it's very important that you do not let go of that winning trade. You want to let it run to at least New York Open. Okay, and if you are very gung-ho about it being a late in the day close past London close, or maybe 1800 GMT, okay, you're going to have to be willing to sit through a New York Open bounce or retracement. So understand that within this profit release phase, there may be several retracements, and you have to be willing to absorb those retracements and trust the fact that the daily range is fulfilling and posting its entire maybe average daily range. It may be reaching for a previous day's high or low. We're not going to get into price targets or anything like that, but we are focusing on the time measurement of looking for the daily range to be fulfilled. If you're getting in London Open, in this instance, if it's a short, you want to be looking at New York Open as your first objective time-wise, and then maybe even expect a bounce in there and give you another sell-off going into the 1500 GMT time. 1500 GMT time, to me, I think is a good time to really tighten up your stop and look for, if you're going to catch any more follow-through, reach obviously for 1800 GMT, but you'll find many times that 1500 GMT, by that time we've either started consolidating or we'll get a London close back into the range scalp. But we're not going to cover that here as well. But that's the profit release phase of the market. So we covered all three cycles or phases, that being the smart money accumulation phase, the smart money distribution phase, and in between, the most important and the only way we make money is when the smart money has accumulated enough positions. Once they start repricing and allowing the market to move during this profit release phase, that's when you want to hold on to your winning trade, because you want to allow that daily range to fulfill, and that's at New York Open, from London Open, 1500 GMT and 1800 GMT. Okay, so those are your time targets for the daily range. Alright, now we're going to talk about the power of 3. So what do we do with this information? Alright, let's assume for a moment that we sit down in our charts. Okay, we're doing our analysis and we're looking at today. Okay, this candle here is going to represent today. Now we notice that just below where we're trading at presently, there is a key support level. Okay, this key support level may be an old daily high, it may be a weekly low of some kind. We're not going to go into great detail what it is that's making it a key support level, but we're going to assume for a moment that you understand what a key support resistance level is, and it's basically found on the higher time frames, going down no lower than 1 hour. Typically you'll find it at the weekly, daily, and 4-hour. Now assume for a moment price starts trading down the next day. Okay, so now we're going to assume that the first bar was a Monday. This bar here represents a Tuesday. We could be reasonably expecting on Wednesday price to trade down into that support level. Now this is when you want to start building the skill of anticipation, not reaction. You don't want to be reacting to the market. It's very important that you understand what may unfold in terms of price action, and in that way, by preparing a game plan based on that anticipation, you stand a far better chance of profiting and controlling risk. Okay, the next day price trades down into this key support level, and always assume that it may trade just a little bit through that key support level. It's never perfectly black and white. You're going to have some gray areas, and you allow for some slippage through these support levels, because there's nothing perfect, especially in trading. Now once it trades down into that support level, there's two things that can happen. One, you can look for SMT divergence as it trades right into that support right here on this candle, and look for optimal trade entries to scalp and catch bounces in here. Or you can wait for a higher low, which would happen on this would represent Thursday, and I'm only using days like this just to classify and keep track of where we're at, because this is a diagram, not an actual price chart. So if this is Thursday, okay, we have trading closing, we're getting ready to go into a Friday. We would reasonably see a swing low in formation here, and the swing low is represented by this low here, surrounded by two higher low candles, which would give you a swing low by my definition. Okay, on your MT4 platform there's an indicator called a fractal, and the fractal forms when there is two higher lows on either side of a low, and it's basically a 5-bar candle formation, and you can trade that, or you can trade this 3-bar pattern. I'm a little bit more astute in price action, so I have no problem using just the 3 bars. So I would be trading on the Friday. Now you, as a trader looking for confirmation and using the fractal indicator on MT4, you would wait for this formation. Okay, so now you would have your typical fractal swing low on your MT4 platform. Now, you're going to give up some price movement if you wait a lot of times using the 5-bar candle formation, which is the reason why I look for the 3-bar formation, because I would actually be trading on this day here. Now, on that day, or after the fourth candle making the 5-bar swing low formation, what are you looking for? Well, you're going to look for the open, and price will trade down, giving you a Judas. Okay, and we're going to wait for price to move down away from the opening price. Now, the opening price is going to be the new session day, and looking at the opening price after New Zealand opens. Okay, so New York's closing, New Zealand's going to open, going into Asia, you want to get the opening price there. Okay, your platforms, obviously you can go in there and get that opening price. You want to draw a little line on your chart, reference that as the opening, and just look for any kind of movement down away from that opening price. Now, it may trade down into a pivot level, it may trade down into optimal trade entry, it may trade down into a confluence of support and resistance and fib, or trinity level. So there's all kinds of different ideas that you can use, but you're basically only looking for price moving down away from that opening price, because your premise is that when it moves down, this is when smart money is going to accumulate, because we have now a swing low on the daily chart, so we could expect at least a very short-term bounce higher. Even if it only goes up for 1 or 2 days, it still stands a large probability that you could profit from that. Again, we don't have to have the direction on the long term 100%. You just need to have a small little edge, and this is one way you can do it. Now, once price trades back above the opening price, anyone that was shorting, okay, below the opening is now trapped. If you were able to assume a long position underneath the open, you would have nailed down a very solid entry price, and you would be in a very good position to be holding for the daily range. When price starts moving up above the opening, it's very important that you do not get such a rush to get out of the market. You start looking for the time of day to give you an indication, and start looking for technicals to get out. Okay, you want to be looking at New York Open, okay, 1200 GMT. You want to be looking at 1500 GMT and 1800 GMT. At some point, price will trade up, make its high for the day, fulfill an ADR maybe, trade for pivots intraday. Let's assume it traded up to 1500 GMT, then traded back down into a little bit lower and closed off of the highs. Okay, that's your typical distribution phase, okay, where market trades up, makes its high of the day, and then consolidates into the close, and then the cycle would repeat the following day. Now let's assume the opposite is unfolding. We're looking at our price charts. This is where we're trading at today, and you notice where we're trading there is a key resistance level that we're approaching, or just a little bit above us. We don't trade just simply because we're going to be trading. We have to be trading near a key support resistance level. Now, as price would move higher and start approaching this key resistance level, again, this would be on a weekly, daily, 4-hour, and no less than a 1 hour to determine a key resistance level, we would reasonably expect price to trade up into that resistance level. This is where you anticipate a trade. You do not get in there ahead of time. You wait for price to go to a specific support and resistance level. That's where the reaction is going to happen. You don't want to be in such a hurry that you try to get in before the actual setup unfolds. As price trades up into this resistance level, okay, now you're going to wait for an SMT divergence, maybe from previous highs. You can get a bearish divergence in the SMT, turtle soup patterns, okay, anything that could be viewed as a reversal pattern intraday could be looked at as a possible entry for a scalp. However, Power 3 suggests that we're going to wait for the daily chart to post a swing high. This is represented by the 3-bar pattern here, where we have a high at a resistance level. So we have an anticipated reaction zone. There is a higher high between two lower high candles represented here. This is a swing high, 3-bar swing high. If this occurs at a resistance level, I would be shorting on the very next day, this candle here. Now, you would see this fractal formation, and then you would be trading the next day if you were waiting for that little arrow to appear on your chart. Now, you can do that and use the same structure we're going to discuss here, much like we did with the buy situation, but I would have been trading right on that candle there. So once we have a high with two lower highs on each side, the very next day, I'm looking for the following. If we were looking for a buy situation before, all we're going to do is going to flip the script, and now we're going to look at the situation where we're going to be looking for a sell. That would look like this: the opening price. Okay, in Asia, we're going to be looking at where we're trading, and we're going to be moving up away from that opening price. That's going to be the Judas, okay, or the sucker play, making everybody believe we maybe made it a low, and now it's going to trade higher. But in fact, what it's really happening is that's the smart money setting up a slaughterhouse, so that way they can take suckers in, and they will sell them their long positions, and then you'll have the distribution phase enter into market, and price will reprice on the other side of the opening price, trapping those that were trying to get long, and price will drop lower, going in deeper into the daily range. Now, it's very important that once you get this nailed down, you do not get in a rush to exit the position. Okay, you have to have some time flexibility, okay, really, and just learn to leave the charts alone. Come back in a couple hours and check it. Okay, do not be focusing on every little minor pip. Focus more on time. Okay, this is how you make money in trading. You don't watch the pips, you don't watch the price up and down. Once you have the trade in there, if you have your stop placed, then you just wait for price to move, and the only way you do that is you submit to time. And it's a very hard trait for new traders and struggling traders to acquire, but you must absolutely submit to time. Look for price targets around the New York Open at 1200 GMT, 1500 GMT, London close, and 1800 GMT as possible time targets for the daily range to be fulfilled. At some point, when price has dropped far enough into maybe an ADR fulfillment, maybe 4 pivots, maybe the swing projections have all converged, at some point price will trade off of the low and consolidate, going into a new trading day where the cycle will repeat itself. But the close typically comes off the high, and this is when you see the smart money accumulation phase. So they're going to accumulate now the short positions they had placed for the day.